Hello, everyone, and welcome back to the J22 Report. I'm your host, Johnnie Market. You all know that drill. Hit that like button and subscribe if you already haven't. And just want to do a little disclaimer. My videos are not to be construed as financial advice. They're just my opinions and my thoughts on the market. If you are going to invest, seek a financial professional or advisor. So let's get into today's stuff. Big news today. I'm hoping to do one more video tonight this weekend. There's some things I wanted to get into, but this will just be about some articles that piqued my interest. I'm going to talk about them, share them with you, and I think they're important. So here's first off: Macy's cuts sales forecast as department stores struggle to draw shoppers. So it did beat quarterly expectations, but look at this, closing 150 namesake stores. So I would say this just goes to show that the consumer is, on its last kneel, that it's starting to really cut back. It's looking for relief in prices, but look, cuts its full year sales forecast Wednesday. Look at this: selective shoppers and more promotions. And this is what I was talking about with what's it called again? Oh, the car sales. They have to create more incentives, sales, promotions, BOGOs, buy one, get one. So their margins are declining, but also the number of sales are declining. So it's not like, all right, we'll decline our margins, but we're going to increase the number of sales. They're losing their margins and the sales. So we posted a mixed quarter. So here's the things, but you can read this for yourselves. Look at this. Gives us the flexibility to address the ongoing uncertainty in the discretionary consumer market. Well, there's no uncertainty. The truth is there is certainty. And that is the discretionary income, unless prices fall, unless we get deflation, is going to go down. So, sorry, I'm taking off my glasses for those who are looking. I had an eye itch. Yeah, as long as prices like rent, food, stuff you need keeps climbing, and those are two big ones. Everyone talks about gas. They love talking about gas because if gas prices fall, only people that really take a haircut are the ones that work in the oil companies. But the reality is the structural problems of this economy is asset prices, meaning uh, stocks were inflationary driven, so they have to come down, and also housing prices. People that have home equity, that's a lot of the boomer population. It's inflated. They'll have to take a haircut for an economy to be actually stable. I mean, everyone's going to take a haircut if we don't address this problem the correct way. Right now, inflation is going to keep going up, and pretty soon no one will be able to afford. And property taxes on homes will be so high, no one will be able to afford housing. So either you lose equity or you're going to lose your house anyway. That's just the reality. So look at this. We see that there's definitely softness, a carefulness, and a delay in the conversion of purchasing. And people on the things they want and the things that are priced sharply on the newness, they're responding. But consumer, even the affluent consumer is not spending like they were a year ago. Yeah, well, the inflation, they were telling these people, and the affluents they're the ones that are more likely to be suckered by the propaganda because they had it so good. Why not believe NBC and everything? They're the ones that were told, oh, this is just transitory. So they kept spending. In reality, is like, no, the higher prices are here to stay. So even they are getting hit now. And that's the thing. No one wins with inflation. There's this myth: asset prices. Inflation gets that bad, no one's going to win, not even gold holders. So there it is. Even then, look at this: shuddering I already talked about this. But they are investing in roughly 350 locations that remain, but it plans to close locations by early 2027. Yeah. Well, that's what happens when their margins are squeezing. They're going to go layoffs, and that's why a recession is inevitable. So there it is. As you can see, even Macy's, and I bought a suit from Macy's. It's a very nice store. It's a very nice store. So this isn't like a really bad. A lot of people want to brush it off, like, oh, that's just they used to do this all the time. Oh, that's just that store. That's a you problem, not a no. This Macy's is a study of an academic, economic problem, a macro problem, not a micro. So Macy's, and I've done so many. Just go back to my videos, the past 3 or 4 months, just showing all the stores that are struggling. So Macy's, they're having problems. Add that to the list. So anyway, here's another one. Studies finds people bet on sports instead of investing in the stock market. Now the bulls will say, well, that just shows that there's no more there's more room to run in the stock market, and this shows we're not at the top because normally people are betting on crappy. This case, well, you can make that argument. Another argument this means is people are more comfortable with betting on sports because they watch it every day, they play it, they may play it, even if they don't play it, they follow it, they've followed it a long time, so they know more. So I think they're making more of a bet on something they know. A lot of people don't know finance, economics. I don't sports bet. I do the finance market because I know, honestly, know a lot about sports. Got offered to play at a pro level, not in the U.S., but I am not. I would not bet on it because there's so many things we don't know. That's the truth. They hide a lot of stuff in that industry. Very. As my friend at AIH Sports says, hanky panky. Just one example is 2017. The Astros weren't the only team cheating. If you believe the official narrative, then you believe Yellen and Biden too. There was many teams that cheated like only one got singled out though. But anyway, let's get back to finance. And I think that's part of the reason. I think also is, a lot of people when they bet on stock markets, they just buy on index funds. They buy index funds, they buy the Spiders ETF, or they buy maybe a couple of stocks. They need a big return. So sports betting is a much bigger return. I also think it's the accessibility. If you look at all these new sports bet websites, not that, just the marketing. They probably listen to podcasts on sports betting way more than they do. They probably listen to sports podcasts way more than they do finance, like Bloomberg, CNBC. Not everyone's a finance nerd like me, and so I think a lot of people are more likely to bet on sports. They're familiar, they watch it all the time. And I would say also, when people, if you look at the Vegas casinos, a lot of those people who use them are very poor, looking to make a quick buck. This is a bad sign for the economy, the sports betting. It means they need a quick buck, and this is something they're familiar with. They don't have to do much research. And so they are looking to make a quick buck, especially if you think you have an upset pick. You can make a lot of bucks. You can pay a bill that's immediate. You don't have a long-term pot presire. So this is a bad sign. This shows the economy's bad, a recession's coming. That's really what it is. It's not a thing of the top of the market. It shows that people, when they get, no, they don't have much money and they're not going to make payments anyway for their next bill or whatnot. So why don't we just bet on, the Jets winning? Why don't we just bet on, or you know what? I need 1,000 to 1 shot. Why don't I put money on like the Jets winning the Super Bowl? They're low contenders. Aaron Rodgers coming back. I'm just looking at Jets to win the Super Bowl plus 2,000. Aaron Rodgers is coming back. Who knows? Maybe they will win. Maybe there is. So that maybe they take because they have very little money, they take a lot of bad teams. They just put it across the board and they're hoping to make one. So this is a very bad time because when people have a lot of money, they don't gamble much. Or if they do gamble, it's very little. So my opinion, not telling you what to do, not investment advice, but don't gamble. If you do gamble, go seek help. I don't gamble. I refuse to gamble. I know people with gambling problems. They've lost a lot of money. I remember I used to work with someone who had a gambling problem. I'm not going to say his name. That person literally into service to get away from gambling. So don't do it. And if you are doing it, seek help. It is not. It is not. Yeah, it's not a good thing. I don't even play poker. I would think it'd be cool to be good at poker because of the things like all the hats and everything they have to make it look. But yeah, just not telling you what to do. But I would stay away from gambling as much as you can. Uh, so anyway, let's go to the next one. Shows how bad the economy is here. USA Today, value meal wars heat up as more fast food spots, restaurants offer discounted menu price. I can see this because I have a lot of apps and I generally go out unless there was like a celebration. I had a celebration this weekend. Took my wife out to a nice dinner. But we'll offer discounted menu meals. You can see it by McDonald's, they're $5. I might actually try that one day. Wendy's, but it's not just this. Olive Garden and IHOP has $5 all you can eat. These companies are so desperate to get people in there that look at all that and this just goes show people aren't going to fast food anymore. I remember I stopped eating Chick-fil-A breakfast last year because it was so much. And it wasn't even health reasons. I should, I have cut back on fast food and everything and a lot of other things just for health reasons, but it was getting ridiculous how much money Chili's expanding 3 for me deals. Yeah, a lot of these specials were horrible anyway. But now they're actually going to have to like give something in return, like buy a hamburger or get the hot dog free. Yeah, coming Monday, August 26th, never ending pasta bowl. So if y'all want to eat at the Olive Garden tomorrow, it's all you can eat pasta. So if you are looking, so I mean, I've never been to the Olive Garden, so it's but yeah, if you look at it, and I love it. The catch the buzzword is value, but the reality is it's value meal. It's poor customers. That's what it is. Americans are poor. They can't afford to go out to eat much anymore, so they're not going out to eat. So let's get into that. So there's another thing. And then just to show what I say, how corporate America is just we have a crisis of confidence. Recession mentions are at a 3-year low for corporate America. And that could be a contrary indicator because they're not all that bright in corporate America. Amount of companies actually discussing recession with investors during conference calls is near its lowest in 3 years. So yeah, the big money, people are detached from reality. But as you can see, I'm showing you all the evidence. Right here, I'm showing you, if you've followed my videos, you can see that we're really coming down. So this is really, they talk about the Sean rule. I don't really care about that. So, I mean, I'm not saying it matters, but I don't care enough to talk about it. And if you want someone to explain you about the Psalm rule and everything, I'm not the right person, so I'd be wasting your time talking about it. So there it is. Corporate America, this is probably a contrarian indicator, if anything. And then here we go, one last one. This is what I talked about. Goldman Sachs is a perfect example. They had to be bailed out because they have no prevention It's always growth, growth, growth. Goldman Sachs is no longer worried about a recession. Its top economist reveals the reasons behind the call. Yeah, that's probably this is probably a more of a they talk about the unwinding of the carry trade. I didn't really talk about the too much, but the economy is doing fine. So as you can see, yeah, July. I love how they say rebound in July. That's seasonally high, and a lot of them are seasonally adjusted, so it's not really a high. A lot of them, it's not real economic activity. They just seasonally adjusted. So, but yeah, as you can see, these are contrarian. Goldman Sachs no longer worried about its top, like whatever reasons. But let's get into this. Stop sharing. But that's all I say. You can see a lot of struggling. The consumer struggling. They're massively betting on sports betting. Now, some of it is the deregulation and familiarity, but also they need a quick buck. They need a quick buck. You can see a lot of corporate America selling, and you're literally walking up and slapping them in the face, and they can't see it coming. That's one thing that really hurts right now is a lot of people, I would say in North America and the leadership in other countries, they're just delusional. They don't really know what's going on. That's why in '08, they had to beg for a government handout to stay in business, and that's probably going to happen again. I don't know, and then that's going to create a bond crisis, and the government's going to bankrupt. You'll see a lot of bankruptcies, and we'll see a recession, a bear market like the Great Depression. It will start later this decade. I think it will start after the election, some of the bad things, but the actual acknowledgement maybe a year or two. I still think this stock market has room to run up until 6,000s, up until 6,000, somewhere between there. But yeah, that's all you can see. The economy is doing poorly. We're seeing cracks in the system. And the good news is, contrarian indicator, corporate America doesn't see a recession. Here's Goldman Sachs. So no one's saying recession this time. So if everyone's screaming recession, generally it won't come. Doesn't mean it does. Like 2007, everyone was screaming recession, then '08 happened. So, and if you look at it, 2018 was a bad year for the market. It wasn't like a bear market or anything, but they had to cut rates 3 times in November in 2019, and they used uh the cookies 1.9 as an excuse to start doing QE. That's when the inflation psychological genie was out of the bag. That's why I always say the Fed's going to cut rates. Things are really bad. They're seeing what I'm seeing probably in Macy's and every Amazon struggling. Walmart's only doing well because the affluent consumer can no longer shop at the hoity-toity stores, and they can't afford to. It's just what it is. The affluent, even the affluent class is getting poor. So that's all I have to say. And they're going to cut rates. But the thing is, the inflation genie's not out of the bag. They have to be willing to publicly acknowledge, whatever way, say or by action, we're going to let asset prices fall. And if they fall, they're going to have to rise on their own. We're not going to provide monetary stimulus. We're not going to help the economy. We're not going to put the economy on life support. We're not going to try to boost up the economy if they fall. If they fall, then it's possible they can stay there. But if they don't stay there, it's because they got back on their own. They increased earnings, revenue. The areas were good, but we're not going to help them get back up. They're going to have to do it on their own. So that's the only way to conquer the inflation mindset is the way Volcker did. He jacked interest rates above inflation and he imposed a recession. And that's what happened. So anyway, they're not doing that now. And I don't think they're doing, and you can tell they're not, because they're talking about rate cuts when inflation is super high and prices of everything are still skyrocketing. So hit that like button. Thank you if you watched all the way through. I do appreciate it. Thank you very much for what if you made it this point. Hit that like button, subscribe, turn on the notification, and I will see you next video.